So an entire generation of entrepreneurs and tech investors built their entire perspectives on valuation during the second half of a 13-year amazing bull market run. The quote unquote unlearning process could be painful, surprising, and unsettling to many. I anticipate denial. Number one, and maybe we could just do these point by point. We don't have to. I'll do two at a time. Number one, previous all-time highs are completely irrelevant. It's not quote unquote cheap because it is down 70%. Forget those prices happened. Yeah, I screwed myself on that first one. Second one, valuation multiples are always a hack proxy, dangerous to use. If you insist 10x should be considered amazing and an upper limit over that, silly. So let's sit on those two for a second. Would you mind just expanding on either or both of those?
There's an unfortunate reality in the venture world that really became very crystal clear to me through a conversation with Howard Marks, actually, but it's structurally set up. You know, people talk about boom bust and cycles, but this is set up more like a sawtooth. So risk on happens very slowly, almost like the roller coaster, going up.
Yeah.
But when it crashes, and if it's interesting to you, I explain or do my best job of explaining why it's structured this way. When it crashes, It happens all at once. So it's more like a sawtooth, than a sine wave. Mm-hmm. And it just crashes and it's painful. And that just happened. And it looks like it happens every 7 to 15 years, and I thought this was going to happen 6 years ago. I even wrote some things. I was way early. It took 6 more years and it got ridiculously crazy. But it took so long from 09, which was the last and 09 wasn't as hard a reset as 01, but from 09 to 2013, because so many entrepreneurs are young, you had people grow up that had never seen a reset. And risk on is a lot like the boiled frog. Like, you don't know it's happening.
Would you mind just quickly defining risk on for people listening? What do you mean by that?
So the community as a whole takes on more risk gradually without realizing they're doing it. And their mental models and their frameworks adjust daily to what's happening. And so their thought about how the world works is really a window of 5 years or maybe 3 years, not 30 years.
Yep.
Because for many of them, they don't have the 30-year perspective. And when the going gets good, greed takes over, and you weigh the data points that feel good to you and are going to make you
there's a lot of confirmation bias.
Like crazy. And so then you've shortened your window to the last 12 months. This is how the world works. And because things got so sloppy with interest rates being near zero, speculation so high, money everywhere, we taught a lot of people not only valuation things that will never be true again, but like growth at all costs. Spend as much money as you can. You can raise money every 9 months if you want to, because you could. The failure rate of companies in the 5 years prior to this reset is probably it's super low, probably the lowest it's ever been, failure rate of startups, just because it was so easy to raise money. And so you develop mental models, and then the world shifts dramatically, 180 degrees, whatever you want to say. It couldn't be more dramatic how fast it shifted. And, even today, entrepreneurs will say, well, I just need to hold on until things get back to normal. And I'm not the only one. There's other VCs going, this is normal, dude. That was a fantasy you were in, and you need to forget it fast, but you can't. And there's another painful thing that I don't even jest about because it creates real problems, and it's actually quite unfortunate. But founders, whatever that peak valuation is, they ran the math where they took their ownership, they multiplied it by that number, and they thought about their net worth that way. And that can just be super destructive, once it's no longer true.
You mean psychologically destructive?
Psychologically, yeah. I think it's super difficult to come to terms with once you've been through that.
What do you mean by valuation multiples are always a hack proxy?
So this gets into some of the earlier stuff we talked about, just about how deep you go on investing. history and understanding investors. But if there is a scale of financial sophistication between 1 and 10, and you would say a really smart person in New York is an 8.5, the average Silicon Valley person on financial literacy is a 2. Like they just, and it's funny because they make fun of Wall Street, but it's just out of ignorance. They don't know anything. And so most of them think about valuation by a price to revenue multiple, which couldn't be a cruder tool. And at one point I wrote a blog post called The Keys to the 10X Revenue Club. And I took all the public tech stocks and laid them end to end based on price to revenue. And one of them was at 20 and one of them was at 0.1. And it was just a big curve. So there's no line there. There's no reason to believe that price to revenue is how you should value anything. But just because it's easy and these companies are young and immature, it's hard to do a DCF. It's hard to do something more sophisticated. It's the common language of the group. But things changed overnight. And so someone was pointing out, I think on Twitter, that, and they used price to gross margin instead of price to revenue still, Twilio went from 70 times gross margin to 3, like in a very short window. I mean, talk about valuation reset. That is just radical. And so that shakes the industry. Yeah. And no one's going to feel sorry for Silicon Valley, and I'm not trying to elicit empathy, but it just in terms of understanding what happens, it is so foundational. The change is so radical that the best thing you can possibly happen is if you can adjust your mental models fast and get on with the new world, but it's very hard for people to do. And I write that this kind of stuff in part to help the industry. And I'm super grateful. Sequoia in 2009 put out, there's a famous deck they put out, So Long, Good Times or something like that. And these things help people adjust faster. Yeah. Having mental models, having structure, having smart people tell them it's okay, it gets them there faster.
That I think relates to number 3. And you mentioned DCF just for people who don't have that reference, discounted cash flow. So number 3 is you may be shocked to learn that people want to value your company on FCF. That's free cash flow. Am I getting that right?
Yeah.
Yep. And earnings. Facebook trades at 14 times GAAP EPS. Am I pronouncing that correctly?
Yes.
Yes. And is growing 23%. What earnings multiple are you assuming? ? So could you just walk us through that bullet?
Yeah. No, I'm going to use a little bit of detail so you can understand. But like the point,
I am at best a 2 on the financial literacy.
If you think all companies should trade at like 10 times revenue, here's one of the most successful companies of all time that is producing massive amounts of positive cash flow and GAAP audited earnings that's trading at a very low multiple of those GAAP earnings. And earnings are a small percentage of your revenue, right? So if you're trading at 10 times revenue, you're probably trading at 50 times earnings, right? And here they're trading at 14. Or you may not even have earnings because there's a great graph. We should try and find one so that someone can see a link of the percentage of companies at IPO that are profitable. And it's this nice cyclical wave that goes with these boom bust cycles.
We'll find it and put it in the show notes. Yeah.
So Wall Street does risk on also, right? And so in really dark times, the percentage of companies IPOing that are profitable is like 90. But by 2020, 2021, that number is 5%. Like the vast majority of companies are losing money as they go public. And Wall Street's encouraging that behavior. And so I've often said to Wall Street is the buyer of what venture capital produces. And if Wall Street wants high growth, money losing businesses, we will create as many as they can possibly consume. Because those are a lot easier to build than the profitable ones. Way easier. Yeah. That's part of why you end up in this cycle thing. The point of highlighting that is just to try and get entrepreneurs and founders reset on where the world is today and where valuations are.